This is the Retirement Key Podcast with Joshua Barbin, certified financial planner of Abish Financial Services.
Welcome back to the Retirement Key, where we are all about giving you the tools and the confidence to take control of your financial future. I'm Casey Biddy, and I'm here with certified financial planner Joshua Barbin of Abish Financial Services right here in the DC area. JB, great to see you.
Hey, Casey. Great to see you, too. Thanks.
I'm very excited to get into it with you today. But before we jump in, quick reminder, if you'd like to connect with us, you can head over to theretirementkey.com. From there, you'll find tons of resources to help you get started with JB and the team there at Abish. Again, that's theretirementkey.com. All right, JB, let's dive right in today. I want to get into a little investing 101 lesson and really break down the basics of investing in a way that feels understandable for our listeners. So let's just start right at the very beginning. What exactly is a stock? Why would somebody want to own one?
Sure. So let's think about a big company that everybody knows, like Apple, for example. A stock, if you owned Apple stock, what essentially you own is a little piece of the ownership of Apple. And so being a stock market investor means that if Apple sells enough iPhones that they're making more money than they're spending, I'm keeping this a little bit simple here, but if they're making more money than they're spending, then you could be potentially making money as well. That's basically the highest level of stock ownership.
Well, I like thinking about owning stock as you're not just sitting on the sidelines, you're a piece of the action. So I love that. Now, what about bonds? I think people sometimes maybe confuse these two. So how is a bond different from a stock, and what role do bonds play in somebody's portfolio?
Yeah, that's a great question. I almost want to bring it to a personal level just because I think it might be more understandable. Imagine you take out a credit card or something like that, and you run up $10,000. You now owe $10,000 to American Express or whoever it is, right? That is sort of the way that a bond works. Apple might do the same thing. They might want to raise some money in the markets. They don't necessarily want to give a piece of their ownership, but they might want to raise some money, so they'll sort of take out a credit card. That's sort of how bonds work. Now, when you're an investor in these things, let's say if I have the choice between investing in an Apple bond versus an Apple stock, an Apple bond is more likely to be paid back to me. Apple stock, well, it could go to zero, it could go to infinity. There's sort of it's dependent on how well Apple will sell their iPhones. Whereas the bond, they're going to need to pay it back. Even if they go bankrupt, they're still going to have to pay it back. Right. So that's sort of the difference between owning the two of those. Well,
it's nice to know that not every part of your portfolio has to be super high risk. It's about creating that balance. Now, moving on to mutual funds. This is another term people hear a lot, but maybe they don't fully understand. So, JB, talk to us about mutual funds and how they differ in investing from individual stocks or bonds.
Yeah, a mutual fund would just be a pool of stocks and bonds. So what, and I've seen this before, people have come into my office with millions of dollars just in a video or something like that. And, that's can work as an investment strategy, but it can also be extremely terrible on some level because you could whip around your net worth. Yeah. So that's called concentration. So what the mutual fund does then is it sort of solves that concentration problem by adding a basket of stocks. So let's just start with 10 just to keep it simple. Mutual fund might have 10 stocks, and that way they could diversify across a number of businesses. So Apple might succeed, Exxon might fail. Overall, you still have success. Usually mutual funds are doing more like 50 to even 1,000 stocks. So there's all types of mutual funds that can cover all types of ownerships, not only stocks, but also bonds. Usually the principle of diversifications, it's one of the, there's not a ton of certainty in investing, but one thing we do know pretty well is that diversification over a long period of time really does work.
Absolutely. Got it. Now, what about ETFs, JB? They sound similar, but they're not exactly the same. So can you explain what an ETF is and how it's different from a mutual fund?
Yeah, most of the market in terms of the advisory space especially is moving from mutual funds to ETFs. I mean, the biggest difference between the two of them is the ETF is tradable during the trading day. The mutual fund is tradable after hours. But the other thing that ETFs are bringing to the forefront is giving a lot more diversification, like possibilities and strategy. because of that intraday trading and also really reducing the cost of investing. Mutual funds typically do tend to be higher expense ratios than ETFs. For example, if we use ETFs, we typically want to use ETFs that are going to have low cost, and that's what the ETF has brought to the market.
Well, I love the idea that ETFs give you that flexibility without a lot of that extra cost. Now, let's bring it home for beginners. JB, if someone's starting with, let's just say, a few $100s, and they are trying to figure out where to put it, how should they think about choosing between stocks, bonds, mutual funds, and ETFs?
Yeah, I mean, it's not our typical case as a client, but we do have retirees who ask us about their children or this exact situation, and typically we would use the Warren Buffett rule for somebody who's just getting started, who needs to get a diverse basket of stocks, ideally, wants to keep the cost low. You might use something like a S&P 500 ETF. I mean, there's lots of them out there. They're usually very low cost and efficient to give you exposure to the 500 biggest companies in America. And so that's usually a good way to start until you get over a certain threshold of dollar amount where you can start adding a little bit more flavor in your portfolio, if you'd like to call it that.
It's never too early to start. I think that's super important for everyone to remember. All right, now, I love busting myths, and I know investing is full of them. So what are some common myths or misconceptions that you hear when it comes to investing?
I would say one of the biggest is just that investing would produce a certain rate of return, like 8% every year. Like that kind of myth of the stock market that it sort of averages 8%, and you can sort of plug this into your financial plan. It's going to be 8%, and you could project out 25 years from now with an 8% return. Markets do not actually work like that in practice, especially the stock market, the bond market a little bit more. Markets, Warren Buffett liked to call it like a bipolar, meaning they're up, and they're down, and you can have really long stretches of either really aggressively growing markets and then really long stretches of not growing markets. Now, if you take it over a really long period of time, it's going to average 8%, but it's nothing like that in practice, which for us as retirement planners, is one of our number one things that we're looking at with our clients, especially the ones that come in with 100% stock portfolio. And we show them, this is how markets actually behave. We understand stock market grows like this over time, but here's what could happen if you were to experience one of these downs of the markets, things like that. So I think that's one of the big misconceptions about stocks versus bonds, the idea that stock's always going to be better from a return standpoint on a long enough average. Yeah, it does typically earn more, but the nuance of timing is hugely important and misunderstood a lot of times.
For sure. All right. Well, before I let you go, JB, I'd love for you to inspire everyone listening with a quick story. So can you share with us a client who you helped successfully with these tools that you've told us about today?
Yeah, I think we encounter some of these clients like these 100% stock portfolios in their 60s, and we typically are at least going to make them aware of the other side of that picture. Yeah. And April was a great opportunity for people to find out their actual risk tolerance, because everybody is a genius in an up market and everybody is, feels great about their portfolio, but you actually find out your risk tolerance and the level of comfort you have with your portfolio when it draws down. And I had a now client come in who was working with another firm, and it was kind of positioned in the way that I was describing. Actually, the firm wanted him to be more aggressive. He actively made a decision not to be that aggressive because he had to go against their counsel. And he was whipped around in April. And it just, after that, he said, that's just not the type of retirement plan that I want to have. Even with the safety he built in for himself, he got a taste of what his real risk tolerance was. And when he came and met with us, he saw, this makes a lot more sense for me at this stage of the game, at this age.
Yeah. All right. Well, I think that's the perfect note to end on. JB, thank you so much for our intro to Investing 101 today. Now, if our conversation resonated with someone listening and they want to sit down with you, what should they do? How can they get in touch with you?
Yeah, they should go to theretirementkey.com, and they're going to find amazing resources there and a way to begin the process of working with Abish or talking to us and finding out more.
That's right. Again, that is theretirementkey.com. Whether you're new to investing and looking for an advisor, or you just want to explore more financial education tools, it is all right there for you at theretirementkey.com. Thank you so much for joining us today. Make sure you subscribe to our YouTube so you never miss an episode, and we will see you next time. Thanks, JB.
Thanks, Casey.
Thanks for listening to the Retirement Key Podcast. To learn more about Abish Financial Services, visit theretirementkey.com. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.